Good afternoon, everybody. This is Susan Martin and Doug Drayer's here today.
Hello, everyone.
We're the owners of Drayer Martin CPAs, and we'd like to welcome everyone to our webcast on PPP loan forgiveness. A colleague of ours referred to this as a whack-a-mole game, which is pretty accurate. And so as a disclaimer, any day now, when we get our revised loan forgiveness application, this information will all be subject to change. So we will go with the flow and see how quick the SBA gets that information out. Objectives for today are to understand the criteria for loan forgiveness, review types of eligible expenses and anticipated documentation requirements, which we know pretty well what those requirements are now. Review calculations for reductions in forgiveness due to decrease in FTEs and payroll costs, discuss best practices on tracking expenses, and then go over services that we can provide. So the criteria for loan forgiveness. Of course, you actually have to apply for loan forgiveness by completing the PPP loan forgiveness application. On that application, you need to go ahead and make sure that you have your SBA PPP loan number and the lender PPP loan number. So look through your documents to get that information. You can use the loan proceeds for payroll, benefits, mortgage, rent, and utilities. Loan proceeds must be used 60% for payroll. So that is one change that the Paycheck Protection Program Flexibility Act changed from the 75% to 60%, and the reduction will be prorated if you don't meet the 60%. I know that there was some discussion out there that that was a cliff, but they did come back and clarify that that will still be prorated. The lender has 60 days from receipt of a complete application to issue a decision to the SBA, and then the SBA will remit the forgiven loan amount plus interest to the lender no later than 90 days after the lender issues its decision to the SBA. So if you do end up with a loan, what we're looking at is if it was before, if you got your PPP before June 5th, when that Flexibility Act was signed, you're still looking at a 2-year maturity at 1%. And then for loans that were issued after that 6/5 date, you're looking at a minimum maturity of 5 years for that. So if you had that loan, if it ends up, we won't even talk about this unless it ends up being a loan, but if you did get it before the 6/5 date, that's a conversation with your lender about modifying that loan agreement and what that looks like. So other items to note on the Flexibility Act, the Flexibility Act extends the 6-month loan payment deferral period until the date on which the amount of forgiveness determined is remitted to the lender. And then if you completely forget to send in your application for forgiveness, within 10 months of the last day of the cover period, payments of principal, interest, and fees will begin on the day which is not earlier than the date that is 10 months after the last day of your covered period. And then one great change that was made, if people need it, is you are now able to defer the payment of the employer payroll tax. That's the Social Security portion of that. If you need to keep that cash and wait to pay those amounts, you can do 50% by 12/31/2021 and 50% by 12/31/22. So before, you could not do that if you had also gotten a PPP loan. So let's jump into some of these details. So first, your covered period or your alternative covered period. So the covered period is the first day that you actually receive loan funding. So the date the funds are received. That is now an 8-week period, or you can elect a 24-week period. The alternative payroll covered period, if you have biweekly or more frequent payroll, so then you're looking at the first day of that first payroll period following the loan funding date, and then you're looking at 8 weeks or 24 weeks. So with that change, with the 8 weeks to 24 weeks, you're also obligated to maintain your level of employees that extra 16 weeks too, or it could impact your loan forgiveness. And payroll, I know that there's been some questions out there of cost incurred and not paid. So those payroll costs that were incurred but not paid during that last pay period of the covered period or the alternative are eligible for forgiveness if you pay them on or before the next regular payroll date. And also with that change, we are still waiting on clarification to see if you can request forgiveness early. So like if you go ahead and spend all your money, but you're not at the end of that period for maintaining employees and FTEs and that kind of thing. Right now, we're not seeing anything that indicates that you can actually go ahead and apply for forgiveness if you've done that. So now this is an example of what that covered period looks like versus the alternative covered period. So on the left, you've got the covered period example being that your PPP loans funded on June 1st. So you've got your 56-day, your 8-week period, or your 24-week period going June 1st to November 15th for that longer 24-week period. And then on the right, an alternative period example being your biweekly payroll. So your payroll starts after you've got funded on June 7th. You're looking at an alternative covered period of 6/7 to 8/1 if it's an 8-week. And then incurred but not paid are eligible if you pay them on or before the first regular payroll date after 8/1. So there's some slight date differences depending on what you see. But what we're seeing is with people that are electing to keep that 8-week period are possibly not going to get it 100% forgiven. And the 24-week period is allowing for more of those expenses to be captured and getting to that 100% forgiveness. So that's just something to think about when you're trying to decide which period that you want to do. So I'm going to turn it over to Doug, and he's going to start diving into the actual details of the application.
Thank you, Susan. Before I actually talk about the calculation, I just want to talk about the application in general. It is Form SBA 3508. It is 11 pages in length. First 2 pages are instructions. Page 3 is actually the first page of the application. Page 4 is your certifications. Page 5 is more instructions. 6, 7, and 8, more calculations there. Page 9 is where we're going to list all our employees, and 10 and 11 are more instructions. So the main ones we're going to be focusing on are pages 3, 6, and 9, and I'll try to tell you where we're at as we're going through this. So, so we're starting with PPP Schedule A, line 1. This is on page 6. So this is for employees that earn under $100,000 per year. And that is under $100,000 based on 2019. Any payroll in 2019. So there is a potential that someone could have received a bonus and it would have pushed them up to an annualized basis of more than 100, but for the year they would have been under. I don't know why they put this in there, but it's there. We need to deal with it. So eligible payroll costs are cash compensation, which is your gross salary and wages, tips, commissions, paid leave. And we have parentheses here, not FFCRA, which is Family First Coronavirus Response Act. Those are wages that you might have paid to someone that was out sick with COVID. The reason they're not included here is you'll receive a credit on your 941 for any of those wages. So they're not allowed double dipping here. Eligible employees are employed during the covered period, which is the 8 weeks or 24 weeks. Their place of residence is the U.S. And for this schedule here, for line 1, it is any employees under $100,000 and non-owners. Those will go in different sections. Like we said, tips are fine. Bonus pay is fine. Hazard pay is fine. Catch-up pay is fine. There's no prohibitions against those, but if they If it is over 15,385 or 46,154, depending on whether you use the 8 weeks or 24 weeks, those are the overall limits. So let's go to the next slide. So this is an example of the worksheet that is on page 9 that'll be feeding into Schedule A. So we have 3 employees here, Ann, Becky, and Daniel. We have an employee identifier, which is the last 4 of their social security numbers, and we enter their cash compensation. It's kind of a misnomer. We're not paying them cash. That's what's on their paychecks. So we have the 3 of those employees. And our calculations, what step we're showing is highlighted on the right-hand side. So let's go to the next slide. Now this is where we're determining our full-time equivalents. And this is also going to be on that worksheet. So you take either your average hours paid per week and divide it by 40, and the max per employee is 1.0. So I guess you don't get credit for overtime. There's also a simplified method where if they're working 40 hours, you count them as 1 employee. If they're working less than 40, they're included as half an employee. You can use either one of these methods, but in other steps, we just need to be consistent. Also, if you have lost headcount, someone's resigned, you've terminated someone for cause, someone won't come back if they were laid off, or you cannot restore your operations because of CDC guidance. It might be, say, at Bauer in North Carolina, they can't open yet, gyms can't open yet. We may be able to include those so they won't penalize us for that in the full-time equivalent calculations. So we'll see what this looks like on the next slide. So for our 3 employees, they were all working at least 40 hours a week, so they're all full-time. So we all have an average FTE for each of them as 1. We also had, I believe this is Joe down here, where it says full-time equivalent reduction exceptions. So he left voluntarily. We don't get penalized for him leaving. So this will, this is the worksheet too, which will feed into Schedule A later. So, okay, I already discussed this on the prior slide, but on the full-time equivalent reduction, Joe had left in January and he wasn't rehired. So we're not penalized for that. Now let's look at the salary reduction and how this comes into play. This goes on line 3. You have to calculate this employee by employee. You only need to do this for people whose salaries or hourly wage decreased by more than 25%. So let's look at an example. This is Lucy. Lucy, during the first quarter, made $15,000. Then the next step is take 75% of that, which would have been $11,250. So she was actually paid $12,000 during the covered period, the 8 weeks. So she made more than $11,250. So we do not need to calculate a salary reduction for her. Now, here's an example of a hourly employees. We have Ann, who made $19 an hour during the first quarter. 75% of that's $14.25. Now, for whatever reason, her pay decreased to $13 an hour. You know, the business was hurting. The owner wanted to keep her on, but said, "Hey, I want you to stay, but I can only pay you 13." So she did not meet the 1425 to be exempt from this calculation. So she was $1.25 under the required amount. Then in the next step, we calculate the reduction by taking that $1.25 an hour times 40 hours times the 8-week period. That's how we arrive at the $400. Okay, and here we're just showing that calculation, how that $400 would flow into worksheet, Schedule A, worksheet table 1. So we have the $400 on the upper left. Now there are some safe harbors that we'll show on the next slide. So there's a safe harbor. So for Ann, we wouldn't have to reduce her by the $400 if we would have met this safe harbor. So there's 2 steps we need to pass. The employee's average hourly wage between February 15th and April 26th. April 26th is 30 days after the act passed, is less than the salary on February 15th. Okay, so whatever, for whatever reason, you cut her salary during this time. Then the next step is if the hourly salary at 6:30 or 12/31, if you're using the 24-week, is equal or greater than the February 15th amount. So if you meet that, then you wouldn't have had to do the $400 wage reduction. So let's look at how this safe harbor would be calculated. So Ann was making $19 an hour in February, the 15th. During February 15th to April 16th, April 26th, her pay was reduced to $16 an hour. Then as of June 30th, she was only making $13 an hour. So we don't meet the exception for the safe harbor, and we have that $400 wage reduction.
And just to add in, Doug, so this is done on that spreadsheet that you're keeping for each individual employee that's outside of the application form.
Yes, so there are some calculations that we're doing for these different worksheets and schedules that are not on the SBA application. So there are calculators all over on the internet. So you're gonna have to keep track of this separately somewhere else.
Mm-hmm.
Okay, so now we're on Schedule A again, line 4, which is cash compensation for those making over $100,000. This is again on page 6 of the application. On the left side, the eligible payroll costs, they're all the same as the first example of those making under $100,000. Again, if you let somebody go and you're paying them a severance, you're fine with that. Catch-up pay, again, is fine. Bonuses are fine. But we're capped at either 15,385 or 46,154 in the 24-week example. So assuming they were making 100,000 in the past, they're still making 100,000 during the 8-week period, you're going to be capped at $15,385 in wages. Okay, so as an example of what this will look like, this will be the worksheet on the left-hand side is table 2. That's page 9. That's your employees over 100,000. We have one, Carrie. She makes $100,001. So we're capped at 15,385, and then that flows to page forward again to page 6, line 4. That's where the 15,385 goes. The next slide. This is rocket science here, but Carrie's salaried employee worked the full 8-week period. We get one full-time equivalent for her. Okay, so what I've talked about so far is cash compensation, what's in your paycheck. Now we're going to talk about non-cash compensation. This includes, and this goes on Schedule A, lines 6 through 8, on page 6. Employer contributions for employee health insurance, employer contributions for retirement plans, and your state and local taxes assessed on compensation. For North Carolina, that is our SUTA taxes that are filed on NCUI 101. But in some other states, it might be a local tax, not an income tax, but a local tax of some sort. Also note here that you do not include owners, retirement, or health insurance here. That is included in the wage figures. Okay, so the next item we're going to discuss is owner's compensation. So this goes directly on line 9 of Schedule A. There is not a separate worksheet on page 9 like there is for employees making over less than 100 and over 100. So this will just go directly on line 9. Now for owners, and we think this got snuck in the act a little after the initial release, is they're limited to their 2019 compensation. So if you have an owner that was making over 100, they'd be limited to 15,385, and potentially more if they're using the 24-week period. Again, this is cash. This is where you include their retirement plan and healthcare contributions. But if you're over 100,000, you're going to be capped at the 15,385. Also, this is where you would put your self-employed individual, someone that has a Schedule C or a partnership. Again, Schedule C is capped at 15,385. And in partnerships, they have a little more complex calculation, but You take your self-employment income, reduce it by section 179 expense, unreimbursed expenses, then you multiply it by 0.9235. Basically, what you're doing is coming up with what your self-employment earnings would be that are taxed at the individual level. The documentation for this would be your 2019 tax returns.
And Doug, just for clarification, on the self-employed Schedule C and partnerships with their retirement and health insurance contributions, that's considered to be in that net self-employment income where you're not adding anything else in for that, right?
Correct. Actually, for the self-employed, right, you don't get to add that number back. So for Schedule Cs and partners and partnerships, they're limited to self-employment income, and we cannot, assuming they were under 100,000, we cannot add those numbers back to it, if I have that right.
Okay.
So let's look at Schedule A and how all these different numbers feed up into, I believe that would be page 3 of the application. So we have our cash compensation, line 1, which was for employees under 100,000. That's the 28,577. Now we table next line, line 4 is cash compensation for employees over 100. Line 6 is health insurance premiums. And I think we need a new health insurance company since we only have 5 employees and we pay $25,000 for 2 months. It seems pretty pricey. Line 7 is our employee retirement plan contributions. Line 8 is our SUTA, some unemployment compensation payments. Then line 9 was our owner's compensation, could be S Corp owner or Schedule C or a partner. The total of those, which are actually summed on line 10 of Schedule A, then flow forward to line 1 on page 3. Okay, so for non-payroll costs, now they allow you to deduct some other items. These are the items that cannot be either over 25% or 40% of your loan amount. They are mortgage interest, and the loan had to be in place as of February 15th. Rents for leases, and we need documentation regarding leases. These again had to be in place by February. But if you have a self-rental situation, that's fine. And utilities, they define utilities as electricity, gas, water, transportation. In transportation, they're defining as gasoline for business vehicles and telephone and internet. You can also pay, this is a little confusing, interest on debts that are not mortgage debt. You can't use it for forgiveness, but you can use it with PPP funds. So that's a little confusing, but it's not an expense that'll get you in trouble on the PPP application. Okay, so on this slide, we're showing, this is page 3, this is the, calculation form of the PPP app. Um, our mortgage interest at 15,000, our rent or lease payments of 1,500, and our business utilities of $10,000. Now our next step, and these are the line numbers on the right of page 3 of the application. So we started with our payroll costs, brought in some non-payroll, and this is where we're going to show our reduction. So we had $400 wage reduction for Ann, and now we're coming to a subtotal for potential forgiveness at this point. And I think Susan is up.
All right, thanks, Doug. So yes, now that we're in the adjustment zone of the forgiveness calculation form, we're going to look at this FTE reduction safe harbor. And we want to just look at this before we get into any calculations that would be based on this. So we're looking at Schedule A worksheet, page 9. So if the borrower is exempt from the loan forgiveness reduction based on FTEs, if both of these items are met. So we're looking at the borrower reduced its FTE employee levels in the period beginning 2/15 and ending 4/26. And then if the borrower restored its FTE employee levels by June 30 for the 8-week period or December 31st for the 24-week period to the FTE employee levels that it had during the pay period that includes 2/15. So let's look at what that those calculations look like. So on this slide, let's just say, for example, for that average FTE for 2/15 to 4/26 was 3.5. We're going to look at our total FTE that was in that pay period that included 2/15, and it was 4. So step 2 is greater than the 3.5 in step 1. So we're going to proceed to step 4, and we're going to look at that FTE number June 30 or December 31st, depending on what you're using. But for this example, at June 30, we're at 3. So our safe harbor is not met. And at this point, we're going to have to go complete that calculation. And that's something that you're going to have to put on that piece of that worksheet there. So now this is the number that everybody wants to be 1. So the first option that they give you is for this FTE reduction quotient. So if you've not reduced the number of employees or the average paid hours of your employees between January 1st and the end of the cover period, check here. So I'm hoping that everybody can just check that box, and you're skipping lines 11 and 12. And you're putting that 1 on 13, and that's essentially 100% of that. So you're not reducing it by any. But if there was a chance that you did reduce that, you're looking at the following formula. So you're going to need to figure out what your average FTEs during either a reference period of 2/15/19 to 6/30/19 or 1/1/20 to 2/29/20. And just as a reminder, you're going to need payroll reports to back these periods of time up with these average FTEs for that. So then you're going to look at the total average FTEs during the 8 or 24-week period, again, depending on what you're using. And then you're going to determine what that FTE reduction quotient is by dividing line 12 by line 11. And for this, just as a note, you're including all the employees on here, but not owners. So just make sure this is table 1 and 2 that we've been talking about earlier for that. So this is just the details of that reduction calculation that I kind of just went through, and I won't read through all of this. But again, just a reminder, use 40 hours to determine if you've got hourly employees that are in here on determine those FTEs. But these are the steps that you would follow for this. And they have said in the guidance to round to the nearest 10th when you're doing that. So if we just look at a quick calculation of what that looks like. So we've got average hours that are paid by employee. So we've determined during our cover period for Ann, Becky, Daniel, Joe, we ended up at 2.6. We did this calculation for both reference periods to see where we ended up. So with the the 2019 period, we were looking at 3.1, and for the 2020 period, we were looking at 4 now. So what does that mean? So we want to use the reference period that gives us the higher percentage. So we've got total FTEs during the cover period of 2.6, and then FTEs during the reference period that had a lower number of 3.1. So that ended up giving us the FTE reduction quotient of 0.84. So let's see how that looks on the application. So we've got on the left, you see the PPP Schedule A, where those, the 3.1, the 2.6, and the 0.84 show. And then you can see just the 0.84 that's coming over to the loan forgiveness calculation form on line 7. And so now, what does that all mean? So here it is, the potential loan forgiveness. So we're taking our line 8 modified total, multiply line 6 by line 7. So here, 120 and 0.84. So we're getting a modified total of 101,595. And our PPP loan amount was possibly 110,000. We're gonna calculate that we actually spent 60% of this loan on payroll, and this is Doug's favorite calculation.
Well, this calculation makes no sense to me. So you divide the payroll cost by 6 to come up with this 158. I don't know why they wouldn't have just taken the loan amount and multiplied it times 60%, and that's what your payroll costs had to be more than. So it's definitely confusing, but you take the lower of, so
yeah,
I understand what it's doing.
Yeah, they're trying to make it hard, so.
Right, they've succeeded.
So in this example, we're looking at a loan that's out there of about $8,400 for the piece that's not being forgiven. So I'm going to turn it over to Doug to briefly talk about what documentation that they're looking for.
Okay, so for payroll costs and benefits, you're going to need bank statements or third-party payroll service reports. So you're probably going to be submitting your payroll reports. Tax forms, the 941s, your state unemployment forms. Now, for other expenses such as your retirement plan and healthcare insurance, you'll need copies of statements or invoices and canceled checks proving them. So, you know, there's going to be a lot of documentation. Now, as far as full-time equivalents, documenting them, there's a whole bunch of different time periods we're looking at. We're looking at February 15th of 19 through June 30th of 19, January 1st of 2020 to 29/20. These do not need to be submitted, but you need to maintain them in your records because they could be requested at some point in the future.
Okay, so the best way as far as tracking expenses, so we've seen a couple of things, and I know that there's a lot of recommendations out there. So a separate bank account is always a good option. That may not always tie back to your eligible expenses, especially if like your payroll drafts the net pay and you've got employer taxes in there. One that's pretty effective is doing a separate GL account and using classes. So on your profit and loss, you're able to class the actual eligible expenses and if you need to split things out of an actual transaction, that works pretty well. You always can use Excel. The most important thing is that you have the summary of your eligible expenses in detail, and then you can tie back to all the documentation that supports that. So if that means for you, hey, I work better with paper, I need to make a binder, I need to print all my invoices, I need to print all my account statements, I need to highlight those amounts that come back to that summary of the transactions at the top. I would say do that. Now, just so you know, the SBA is saying that you must maintain this documentation for 6 years after the loan is forgiven or it's paid in full. And they can access those files upon request for those items. So I know we've covered a lot, but we do want to touch on what services that we're currently providing for our clients and prospective clients. So we're seeing a lot of the consulting engagements that you can see here at the top. So we're not providing any assurance that any of those numbers are correct, but we're helping gather documents, assistance with calculations, and drafting of a completed forgiveness application, subject to change when we get the new one. But that's the application that you as a client would submit on your own. We would not submit that for you. And then if there's a higher level of service that you would like, or maybe you've talked to the lender and he said, I would rely on this report, we can do an agreed upon procedures engagement where we're issuing a report that provides limited assurance about what we've agreed to, amounts in the application to supporting documentation that we've recalculated, amounts in the application, and it just gives a list of the procedure that we did and the results that we found. And like I said, that can be either for you as the client or as the lender, if that's what you want. And then as far as resources, you've got the treasury.gov page. I think that one has pretty much everything that you would need to look at that, sba.gov. And then our website, we have the COVID-19 banner that you can click on, and that's updated pretty frequently as these changes are rolling out. So that's an easy way for you to find that information as well. And so that is it for us. If you have questions about anything that we discussed today, I'm sure we'll be doing an update next week when all the more interim final information comes out. Our emails are here. Please feel free to email us if there's anything else. And Doug, if you've got anything to add as we conclude.
No, I would just like to thank, well, yes, I mean, I would like to thank you for putting the PowerPoint together, because otherwise this wouldn't be happening today. Beyond my skill set. But yeah, it's complicated depending on your employee situation. You might have more simplistic payroll structure, but we tried to touch on situation, and we just tried to touch on all of it. But we'll have more updates in the future.
So once again, thank y'all for joining us today, and we hope that this information has been helpful, and email us as you need to. We'll talk to you soon. Thank you.
Bye.